Hi everyone, welcome. Thank you for joining this SLR webinar today on the introduction to EU Taxonomy. Your presenter today is going to be Sam Gill. I'm just going to jump on to take you through a quick bit of housekeeping before we get going. Just to ensure everyone can hear the presentation and to minimize any background, everyone will be muted, but we of course welcome contributions and questions. So please do make use of the question box on the screen and we can pick up some questions at the end when there's time. Thank you very much. I'm now going to pass you over to Sam, and I believe he's going to start with a quick poll.
Great, thanks very much. Well, perhaps just to introduce myself, and then, as we just mentioned, we're going to do an interactive poll to kick off. So I'm Technical Director in the ESG Strategic Advisory Team based in the UK, and essentially I specialise in climate-related work, particularly helping companies with these various different reporting requirements, CSRD, EU Taxonomy, TCFD, and all the other acronyms. And then increasingly, I do more and more work helping companies with their climate change risk assessments and adaptation plans. So this is actually a two-part webinar. So today we're going to be talking about the emerging and relatively new EU set of regulations, how they fit together, focusing on the EU taxonomy. And then next week, I'm going to be talking about how companies can think about climate change risk assessments and adaptation plans. So yeah, if we can start off with this poll, and then we'll go into things. So where are you in your journey towards complying with CSRD, EU taxonomy, or CSDD regulation? Is this something you've already started, something you're thinking about in the next 12 months, something for the next 24 months, or something that you might still be considering if it's something that you need to do? Seeing a few replies already. All right. So Jen, can others see the results to that? So it looks like the majority have already started, which is great. And then we have a few that are looking at starting in the next 12 months. Well, hopefully what we're going to be talking about today is useful, even if you have already started. I think one of the things that's quite interesting with all of these pieces of regulation is that there always seems to be more of them, and sometimes we sort of better understand the interconnections between them. And that's essentially what we're going to be covering today. So really to kick off, and as I said, really the main focus is the EU taxonomy piece, but I just want to set the scene by providing a bit of a overview of the interplay between these different pieces of regulation. And I think what's really important when thinking about EU regulation is trying to understand them as a holistic whole or a combination rather than standalone pieces. So essentially we have these four main pillars, which we'll go through. So CSRD, the Corporate Sustainability Reporting Directive. So that's really all about standardizing sustainability reporting, providing transparency around risks and opportunities, thinking about double materiality, and then it's going to essentially be requiring limited assurance to begin with. That might move on to reasonable assurance in the future. Then we have the CSDD, so the Corporate Sustainability Due Diligence Directive. And that's really focusing more on due diligence and essentially the requirement to identify and address human rights and environmental impacts for not just our own operations, but then the value chain. So thinking more about that value chain piece. Then we have the EU taxonomy. So here, that's what we're going to be talking about today, classifying and assessing whether firms and their economic activities are contributing to the environmental objectives that have been set out in the regulation, and also whether or not they meet these social safeguards. The SFDR, so that's really more focused on financial markets participants, and it's really talking about how investors are integrating sustainability risks into their investment decisions and the extent to which there are principal adverse impacts associated with these risks. So essentially a set of KPIs. So I think just perhaps to talk a little bit about who is in scope. So the CSRD, companies with 250 employees, balance sheet of 25 million, turnover of 50 million euros, that is. And it's really if you're meeting two of those three criteria, listed SMEs, and then also non-EU firms, but if they are listed on an EU market. The CSRD, so that'll be coming in a little bit later. We'll look at a timeline in a second. But that's talking about 1,000 employees or more, and net global turnover of over 450 million. So that's essentially the threshold there is quite a lot more, and that will be covering quite a few less companies, so maybe around 1,000 or so. The EU Taxonomy, so this is perhaps a piece that might not have been captured by everybody, but really if you are covered by the CSRD, then you are in scope of providing EU Taxonomy disclosures. Those who are reporting or essentially non-EU entities as well, if they are in scope for CSRD and SFRD. So yeah, also there if you're covered by SFDR. SFDR, so that's essentially financial markets participants, and then also if you are marketing products within the EU. So just talk a little bit about the timelines there. So essentially, we had the NFRD, or the Non-Financial Reporting Directive, that was replaced by the CSRD beginning of 2024, and the CSRD is going to be phased in terms of increasing the scope over time, but it's already essentially starting this year. The EU Taxonomy, similarly, it was phased in, but it's essentially up and running now. So companies that are in scope are now required to report under the EU Taxonomy. And SFDR similarly phased in to begin with, but also now thoroughly up and running. And then the CSRD, so that is starting in 2027. So a little bit more time to prepare for that one. But yeah, those are the timelines. And so just then briefly to sort of talk a little bit about the relationship between these. So essentially, EU Taxonomy reporting, that is, or the CSRD is requiring information that is being disclosed under the EU Taxonomy. Similarly, the SFDR, again, it's drawing from that information, and sometimes we see some of those reporting requirements being referenced in both of those pieces of legislation. CSRD, so again, that's essentially providing more information in the market for companies that might be captured within a portfolio to then feed into the SFDR. Similarly, the CSRD essentially is helping, or if you like, putting more pressure on companies to be developing processes, particularly in the supply chain, which then would mean that those companies are better aligned with the EU Taxonomy, particularly the minimum safeguards and the do no significant harm elements, which we'll talk about a bit later. And then lastly, I think one thing that's quite interesting with the CSRD is that it's requiring companies to disclose transition plans. What's interesting with the CSRD is that it's not only requiring companies to disclose those transition plans, but it's also measuring how aligned those are with the Paris Climate Agreement. So essentially, it's slightly more stringent when it comes to transition plans with the CSRD, and then the CSRD and the ESRS standards are essentially standards that can be used in that due diligence process. So hopefully by now you're sort of getting a bit of a sense that these are very much interrelated and quite a bit of an overlap between them. So just to perhaps then focus in on the CSRD and the EU Taxonomy and where we are now. So essentially large public and private companies are covered by these pieces of regulation. And although they are EU centric, we're suddenly working with quite a few UK clients that either have significant operations in the EU or that are simply deciding that this is going to become an expectation of different stakeholders, and therefore it's something that they need to be reporting against. So if the CSRD is focusing on those ESG impacts, the EU Taxonomy is really talking about what percentage of your activities as a business are aligned with the EU taxonomy. And then as part of that, you're having to report the revenue, your capex, your opex that is aligned, as well as the various do no significant harm criteria. And the idea with all of that is it's feeding in to the allocation of capital and how civil society views different companies. So just perhaps the last thing to mention here before we go into a bit more detail, the EU taxonomy, is the fact that the CSRD is going to be covering 50,000 plus companies over the next 5 years, which is rather a lot. So moving from those large public interests to larger private companies through to SMEs, and then companies that are essentially non-EU parent companies, but that have a subsidiary within the EU. And so that's quite a lot of companies, really, and certainly something that will be impacting many reporting entities over the next 5 years and beyond. So let's talk a little bit more about the EU taxonomy specifically. And I think really it's helpful just to say, it can be thought about as a bit of a green dictionary or a classification system. And it's really trying to translate the EU's climate policy and environmental objectives into a set of specific activities that can be defined as green. So, sorry, a bit of a cough today. So for each economic activity that is within scope of the EU taxonomy, so in other words, every activity that features within that directive, there is a set of technical screening criteria which essentially is determining what a substantial contribution means to one of the environmental objectives, and we'll talk a bit more about that in a moment. Then it defines what each of those activities would need to be doing to meet the do no significant harm criteria. And then finally, you have the requirement to be complying with a set of minimum social safeguards. And if a company is doing that for each of these individual activities, then it can be considered to be environmentally sustainable. So what does that look like? Well, there are 6 of these different environmental objectives. You're probably quite familiar with climate mitigation, adaptation, and then some of the others maybe a bit less so, but sustainable use and protection of water and marine resources, transition to a circular economy, pollution prevention and control, and then protection and restoration of biodiversity and ecosystems. So this really is covering the full spectrum of what environmental sustainability could mean. And so we saw the first 2 delegated acts focusing on mitigation and adaptation, and then the more recent ones that came out in 2023 provided further guidance for those others. There are also a number of different taxonomies, and we're seeing that in different parts of the world where governments essentially want to adjust their definitions slightly to include different activities that may be considered green. But really at the moment, you could argue that the EU taxonomy is the flagship, most prominent taxonomy that is out there. Obviously, the EU is a very large market, but we may see others in different parts of the world proliferate as well. So just something to be aware of. So let's talk a little bit more about how one might go about reporting under the EU taxonomy and what this process entails. And as I say, quite a lot of the companies that we're talking to at the moment, they've just realized that they need to be reporting under the CSRD, maybe weren't quite so familiar that they needed to also then be reporting under the EU taxonomy. So this is a process that we're now going through to support our clients with essentially adhering to the EU taxonomy reporting regulation. So the way we would typically think about this is that it can be divided into 3 distinct phases. So the first phase essentially is where we're reviewing the eligibility of the activities that a company is undertaking to see whether or not they are eligible for inclusion within the EU taxonomy. And the EU taxonomy essentially is a long list of all the activities that are considered to potentially be sustainable. So it's essentially a matching exercise of the activities a company is carrying out versus the EU taxonomy. And the question there essentially is my company engaged in any activities that are included? If so, you're engaging in eligible activities, and then there is the possibility of alignment, which is not just that they are eligible, but then you're also meeting these various criteria. So that's the second stage, which is essentially to say, is the company potentially aligned? So is it making a substantial contribution to one of those objectives? Is it meeting the do no significant harm criteria? And is it also complying with the minimum safeguards? The next stage after that is essentially to see what KPIs need to be reported. And so the regulation is quite specific about what proportion, what KPIs need to be reported. So that's proportion of turnover, CapEx, and OpEx that is both taxonomy eligible and taxonomy aligned. And that's essentially the final stage, which is that reporting piece at the end. So just to recap then, first of all, is it eligible? That's essentially a relatively binary yes or no. There may be some challenges in mapping different activities depending on the complexity of the business. But the descriptions generally are quite clear in the taxonomy guidance. Then in terms of measuring alignment, so this is focused on each individual activity. So depending on the complexity of a business, you might have 20, you might have 30 activities, or you might just have 1 or 2. So looking at the criteria to see whether or not it's making a substantial contribution, looking at whether or not it's doing any significant harm, and then finally looking at the minimum safeguards. And so one thing just to emphasize here is that these two aspects, which we would call the technical screening criteria, are specific to each activity, whereas the minimum social safeguards would be specific to the undertaking, and undertaking is how the EU regulation refers to a company essentially, or an entity. So that's just one thing to keep in mind, which somewhat simplifies the minimum social safeguards process as you're applying that company-wide as opposed to at the level of each activity. So just to recap then, when we talk about eligible versus aligned, so eligible, essentially, it's an activity that could potentially be aligned. So it's within scope and it has the potential to make a substantial contribution. Whereas aligned means that essentially all of the criteria that is specified in the taxonomy is being met. So substantial contribution, do no significant harm, and complying with the minimum safeguards. So the last part then, when we're talking about these KPIs, essentially there's really three main metrics: turnover, CapEx, and OpEx. There is a little bit more nuance within those, but we can perhaps save for another day. There's various guidance within the regulation about how these need to be accounted for. So essentially, there might be something that your finance team might be looking at in order to make sure that, for example, if you are spending money on an activity, let's say you're putting solar panels on the roof of a factory, making sure that that is being accounted for correctly and you're getting credit essentially for that effort and the capital that you're allocating to that particular activity. A key point here is really that the reporting needs to be transparent, and whatever logic is being employed is really being documented and is consistently applied across the business. So for example, you might have some percentage of overheads that you might be applying equally to all activities, and that's okay. It's just as long as you're making these assumptions, documenting them, and making sure that ultimately they can be auditable. And that's really a key component. With all of these pieces of EU regulation, there are aspects that are going to be expected to be audited, and therefore having an audit trail is really key to how you think about designing a process. So that's a sort of overview of the different steps. Now we'll talk a little bit more about these components on an individual basis. So the first one is this substantial contribution piece. And we mentioned before, so we've got these 6 different elements: mitigation, adaptation, etc. That's what we mean when we say that we're making contribution to one of these. And there's a very helpful online EU Taxonomy compass, which if you are working in this space and you want to have a look at that, I really recommend it. What I personally have found is when trying to interpret these various very long PDF directives, they can be a little bit clunky. Luckily, the EU Commission has made this tool which makes it a lot easier to navigate. So you can go in there, type the activity, and then you can see all of the different potential areas where you could be making a substantial contribution. So here, for the manufacture of aluminium, we see that there are 2 areas: climate mitigation and climate adaptation, where a company can be making a substantial contribution. And so in terms of what that looks like, so we see here, when you click on that button, you end up with a sort of a drop down that explains exactly what you need to be doing in order to be considered to be making a substantial contribution. So we'll just have a look at that in a little bit more detail. So here we have the manufacture of aluminium, we have the economic activity description. So this is what you would be trying to match for your eligibility phase. For example, manufacture of aluminium through primary aluminium bauxite process or secondary aluminium recycling. So essentially, a company manufacturing aluminium through either of those 2 routes is effectively engaging in a taxonomy eligible economic activity. And then you see from the technical screening criteria for climate mitigation, the activity manufactures one of the following. So you would have primary aluminium, where the economic activity complies with one of the 2 following criteria until 2025, and then all of the criteria after 2025. So we see there's, in some cases, a ratchet mechanism where the requirements are increasing over time. And so here, of these 3 elements, so we've got the GHG emissions do not exceed 1,484 tons CO2 equivalent per ton of aluminium manufactured. And the others, for example, then are looking at a carbon intensity or a electricity consumption threshold. And then point B here being that it would be secondary aluminium. So you can hopefully see that when you're trying to understand whether or not your activity would be making a substantial contribution, they're relatively black and white, and it would be somewhat binary as to yes or no, we are doing this. Obviously, you would then need to be backing that up, again, thinking back to that audit trail. So perhaps there might be a GHG calculation or energy usage report or something like that that helps to make that case. So that's one example. Another would be a simpler one, just to give you a bit of a flavor of what they look like. So here, electricity generation from wind power. So here we're talking about the construction or operation of electricity generation facilities that produce electricity from wind power. And to be making a substantial contribution, the activity simply needs to generate electricity from wind power. So that's hopefully very simple and would be quite a lot less effort. A third one, and don't worry, we won't read all of this, but this is looking at nuclear power plants and essentially all of the different criteria involved in ascertaining whether or not that is making a substantial contribution. So as you can see, some are more complex than others, and it does really require actually going into the details of the technical screening criteria, which you can only really have done once you've mapped your activities to all of those within the EU taxonomy. So that's the substantial contribution part. And so now what we're going to do is have a little look at the do no significant harm criteria. So the first thing to say here, so what we've got is a sort of generic do no significant harm summary, and you see the numbers start at 2 here, and that's because most of the time the number 1 is climate mitigation. And so, for example, so where this example is taken from, if you are making a substantial contribution to climate mitigation, then you don't have to worry about doing no significant harm to mitigation, but instead you then have to make sure you're doing no significant harm for all of the other 5 that are left. So essentially, we'll just try and now give a bit of a sense of what is required when it comes to do no significant harm. So climate adaptation, essentially what that's saying is that you need to do a climate risk assessment and develop an adaptation plan. And that's what we'll talk about in more detail next week as well. Sustainable use and protection of water and marine resources. So essentially, this is, again, where applicable and for relevant sites. So it might not be applicable for everybody, but essentially what it's saying is identify the relevant water-related risks, particularly around how you can preserve water quality and also avoid water stress. Develop a water use and protection plan. Include water in an environmental impact assessment. Transition to a circular economy, again, where applicable. So this may include developing a waste management plan. So how are you dealing with those components at the end of their life? Thinking about integration of circular economy principles into design, reuse and use of secondary raw materials, and also thinking about traceability. Pollution prevention and control. So again, where applicable, and this might not be applicable to all companies, but essentially making sure that there's no promotion of the use of harmful chemicals and materials. And then lastly, with the protection and restoration of biodiversity and ecosystems, this really is incorporating into any environmental impact assessment that you might do for a new site, the considerations of biodiversity and local ecosystems. Depending on where your sites are, you might also be doing or be required to do a screen to see if you're having any impact at the moment. So that's a quick overview. And just to kind of give you a bit of a sense, going back to that example of manufacture of aluminium. So this is what it looks like there, where essentially, for the most part, the activity then refers you to a specific appendix, which is essentially the generic criteria for, or generic do no significant harm criteria. So climate adaptation points you to Appendix A, which is the generic way of managing climate adaptation. Some of them might also be not applicable, like the transition to circular economy. And then we see with number 5 here that it actually provides a little bit of more specific guidance, which is then relevant only to that activity. So it refers you to the appendix, but then it also says emissions are within or lower than the emission level associated with the best available techniques, ranges set out in the latest relevant best available techniques, conclusions, etc., etc. So essentially, yeah, I think the key point I'm trying to make here is that every individual activity then has a unique set of substantial contribution aspects, and then also do no significant harm criteria. So we're just going to look in a little bit more detail at what this actually requires you to do. So this is the text. Don't worry about reading all the small print. If anyone's interested, I can send you the slides. But essentially, the physical or the climate adaptation requirement is essentially that physical climate risks that are material to the activity have been identified from those listed in the table in section 2 of the appendix, which I'll show you in a moment, by performing a robust climate risk and vulnerability assessment with the following steps. So just to quickly show you what these hazards look like. So this is the table, and essentially what it does is provide the chronic and the acute. So chronic being slower moving changes like sea level rise, for example, whereas acute would be things that happen quite suddenly, like a wildfire. So this pretty much captures all the climate hazards that could occur. There might be a few that have escaped the net, but 99.9%. I mean, for most businesses, for example, it's quite unlikely, unless perhaps you're based in Switzerland, that a glacial lake outburst might be something that you would have to worry about. But the whole point of this really is to initially do a screen of your locations that are relevant to your activities to understand which of these climate-related hazards is potentially going to cause an issue. And the key thing, of course, to remember is that just because it hasn't caused an issue in the past doesn't necessarily mean that it won't cause an issue in the future, given that the world is warming quite considerably, and therefore leading to more extreme weather events. So that's the idea here. So the first, if we go back, so the first thing we're being asked to do is to screen. So now looking at this point A here, screen the activity to identify which physical climate risks may affect the performance of the activity. There's a little bit of potential confusion here with the terminology, as ultimately, if we look at these are hazards as opposed to necessarily risks. But be that as that may, that's what it's asking you to do. So the first point here being screen for relevant climate hazards. The second point then, B here, is essentially what we're saying is where the activity is assessed to be at risk from one or more of the physical climate risks or hazards listed in the appendix, then you need to do a climate risk and vulnerability assessment to assess the materiality of those physical climate risks on the activity. So essentially what it's saying here is that having identified that some of these hazards might be relevant, then you should move to performing a climate change risk assessment. And then finally, part C here is essentially saying, which would generally be good practice, if you have identified any risks, you should identify ways to mitigate those risks, which in this particular context would be known as an adaptation plan. The small print here, we don't need to go into that, but essentially what it's saying is it needs to be covering the lifespan of the asset, and that you should use the latest forward-looking physical risk data. And this goes back to that point about, it's not really any good to look at a past flood map or past time series of data. Perhaps a site has never been hit by a particular issue. If in the next 20 years we're going to start seeing a massive increase in the likelihood of extreme weather events like a massive downpour and therefore pluvial flooding. So this is the first element then, climate change adaptation. And what's really important, and I think something that maybe not everyone might be aware of, is that this particular requirement, the climate change adaptation, do no significant harm, applies to every single activity within the EU taxonomy. So in other words, if you are required by CSRD to report EU taxonomy alignment, and you have one or more activities that is in the EU taxonomy, then in order to demonstrate alignment, you ultimately will need to do a climate hazard screen, risk assessment, and adaptation plan for your key sites. Unless, of course, you identify that there are no climate risks at all to any of your locations, which I would say is quite unlikely for most businesses, but it is also possible depending on where you are. So then let's look at the sustainable use and protection of water and marine resources. So we won't go into these in quite so much detail, but essentially what this is really saying is that you need to be developing a water conservation and water management plan. As I mentioned last time, the climate adaptation piece applies to all activities. The water one, so this one applies to, I believe it's about 75% of the activities, so quite a lot of businesses will be covered. But it is also whether or not it is actually specifically relevant to you. And it might be that your business is not using that much water, for example, and you determine it's not material. However, you would still be expected to make some determination of materiality if you are excluding something. And then crucially, the idea being that if you are doing an environmental impact assessment for a new site, then you should definitely be including water and making sure that the inclusion of water is aligned with the relevant standards. So that's the water one. Circular economy, again, it might not be relevant to every business, but essentially these are the main things to be considering. So ultimately, does the company currently use any recycled or secondary raw materials, and if is there opportunity to do that more in the future? Are you already incorporating circular economy design principles? And if so, how have these been factored into the design process? Is there a waste management plan? And how have these factors been considered in the process? And then lastly, thinking about substance traceability and management plans. And so SLR also has experience in circular economy and waste management plans. So if that is something that you need support with, then we have the expertise there as well. I should also mention we do also have those expertise for water and biodiversity. So yeah, do get in touch if you need help on any of these. So then, yeah, pollution prevention, control and use. I would imagine that if your business comes under any of these regulations, you would already be quite familiar with these and aware of their existence. But ultimately, it might be worth just cross-referencing the EU Taxonomy if you are in an industry where you're working with any of these types of substances to make sure that you're compliant. And then lastly, so they do no significant harm for biodiversity and ecosystems. So essentially, it's really, I would imagine that, so yeah, either you're doing an EIA when you're looking at a new site, and then there's also the second component, which is just documenting whether any of the company's sites are located in or near biodiversity sensitive areas, which if you're not, then you would essentially be saying, well, this is not relevant to us and therefore something we're not including. And if it is, it would be then, well, have you got an appropriate plan or risk management plan in order to ensure that you're not damaging any of those sites. There are various tools that essentially enable you to easily identify whether, for example, you're close to a Natura 2000 network of protected areas. And again, this might be something that the business is aware of. Yeah, those are the main do no significant harm criteria. As I say, I think probably the most important one is climate adaptation, and that's what we'll be talking about next week. So then minimum safeguards, what does this mean? And this is, I would say, relatively straightforward once you get your head around it, as with many of these things. Personally, I found the documentation not particularly clear, but luckily there's some quite helpful guidance out there. So just sort of recapping then, so in order to be aligned, making a substantial contribution, doing no significant harm, and then that third piece, making sure that the company or the entity, the undertaking, is complying with the minimum social safeguards. So what does that mean? Well, essentially, really it's 4 core topics for which compliance with minimum social safeguards should be defined, and that's human rights, which includes workers' rights, bribery and corruption, or rather anti-bribery and corruption, taxation and anti-tax avoidance, and then fair competition. So it's those 4 buckets. And what is required is that a company would be considered compliant if they meet 2 of these criteria. So the criteria, and this follows the same pattern for all of these, would be that on the one hand, so in this case, talking about human rights, that there's a due diligence process in place, which is then aligned with essentially a set of best practice guidelines, so from the UN and the OECD. So process in place, and also that the undertaking has no convictions against it for breaches of labour law or human rights. So I would imagine for most companies they won't have any convictions against them, but then the question really is, do you have a policy in place that is meeting these requirements? That's essentially the same then for the bribery and corruption one. So yeah, do you have an anti-bribery and corruption process in place? And then again, that there's no court case, final convictions against company or senior management. That also does include subsidiaries as well. Taxation. So again, looking at tax governance and compliance. So making sure that is integrated into your processes and that there's adequate risk management strategies in place. And again, no final convictions against the company or subsidiaries. Fair competition. So again, this might be incorporated into employee awareness and training, essentially to make sure that employees and other stakeholders are in compliance with competition laws and regulations. And again, that there are no convictions against anybody, senior management, for violation. Key point here really is that those processes then need to be publicly available or publicly accessible. So that might be something that you would want to review as part of this process in order to understand whether or not you are in alignment. So some of the clients we've been working with at the moment, in addition to those parts we looked at earlier, looking at eligibility and alignment, we were also then reviewing their minimum social safeguards documentation and suggesting where there might have been some gaps. So just to essentially finish off here, just to sort of explain then the example outputs in terms of what does this look like at the end, and what are you ultimately aiming for. So the regulation provides, the EU Taxonomy regulation provides a template which you are essentially encouraged to use, and there's an Excel version that you can access online, so it could be useful to play around with that. What that actually looks like, if we blow it up a bit, is essentially asking what percentage, so this is just looking at revenue, there's also CapEx and OpEx, as we talked about before, but what percentage of your activities are essentially eligible, and what percentage are eligible and aligned, essentially. So yeah, it's really breaking it down. And then you might have some activities that are not eligible whatsoever. So fossil fuels, for example, is not in the EU taxonomy. So that's a sort of end point, if you like, which is trying to get to this table. But then you would essentially have commentary around that disclosure to explain the rationale, and perhaps there might be certain things that you might be working towards. So you might have activities that are eligible, and you might also be making a substantial contribution, but you might, for example, not yet have done your do no significant harm climate risk assessment for all of your sites. So you might want to tell the story about how you're planning to do that in the future, but might not be just yet. So that's a sort of overview of what you're trying to aim for at the end. And with that, we will perhaps move to see if there are any questions.
Hi, Sam. Yes, just popping back on as we've had a few questions through the chat box. So the first one is, how do companies determine whether their activities are taxonomy eligible or taxonomy aligned? And could you explain how this works in practice?
Yeah, sure. So I think the process essentially that we've been going through with the clients we've been supporting is first of all mapping the business. So really trying to understand the different activities that the business undertakes. I think there's been a bit of a mixture between us as the external advisors working with the sustainability team and the finance team. Some companies would also have a definition of their activities broken down by NACE code. That's very helpful if that already exists, because that's what the EU taxonomy is using. So essentially, it's really a mapping exercise of trying to understand the business, trying to understand the EU taxonomy, and bringing those two together. The eligibility one is perhaps a little bit more complicated in that you're going through a process of taking all of the information. Once you've identified which activities are potentially eligible, you're then going through a process of reviewing each individual bit of screening criteria. So either the substantial contribution elements, for example, it might be that you're meeting a particular energy efficiency threshold, or that you're engaged in certain circular economy practices, and then looking at all of the different do no significant harm aspects. And I would say that part is a little bit more complicated, because it might be, it really depends on how many sites you have, how many product lines you have, and all the different activities you're engaged in. So I think really the challenge there is around devising the most efficient strategy to be able to say, yes, we are aligned or not. And that's essentially what we're doing our best to help our clients with at the moment. Yeah, hope that answered the question.
Thank you. Another question that has come through is, what challenges do companies face when it comes to meeting the do no significant harm criteria under the EU Taxonomy?
Yeah, so I think again, I think that some of the challenges around the site or the scope of the product line a company might have. So a company that has thousands of products might struggle if it was thinking about trying to perform these types of analyses on individual product lines. And so that might be where thinking a little bit about how certain products can be categorized and aggregated, so that instead of trying to do something across 10,000 products, you might be looking at 10 or so groups of product. Another thing that we are seeing companies do is sometimes think a little bit more about the individual locations. So I think if you can try to apply, so if you have major manufacturing sites, for example, and you might only have 10 of those, even if you might have, say, 10,000 products, that type of approach of thinking about where you can concentrate efforts is another way that you can try to bypass some of the complexity around the do no significant harm criteria. But I think just maybe sort of zooming out a little bit, I think what we've found typically is when we work with clients is quite often a sustainability team that is our main counterpart. And so often you might have a sort of task force or working group that might involve more technical managers that might have better understanding, perhaps at the product level or a site level, and also bringing in, for example, finance teams who can help with the allocation of the financial metrics to these different activities. So I think another key thing is trying to bring together the right people to have an effective working group when it comes to this project.
Thank you. Another one that I have here is, with the phase-in timelines for the CSRD, what are some immediate steps that smaller companies can take to prepare for reporting obligations in the coming years?
Yeah, it's a good question. I think as we looked at earlier, there's quite a few different reporting requirements coming down the track. And so I think developing a strategy earlier on would hopefully reduce stress levels a bit later on down the line, but also mean that you can be as prepared as possible. I think one thing that so typically what we do with the CSRD is a double materiality process. And in some ways, it's quite beneficial approach to CSRD is that you're trying to understand what are the most material of your ESG risks as a phase one, so that you can then focus going forward. So we definitely think that is a good approach and something that you can save you a lot of time. But I think the other thing is to be thinking about where are the synergies between all of these different reporting requirements, and therefore what are the types of things that you can do which essentially benefit you in all of these different scenarios. So a bit of a sort of low regrets approach. So for example, within the CSRD, you are required to perform climate scenario analysis work, which also would then support you if you're trying to report to the TCFD or the IFRS S2. So that's something that makes sense in all scenarios to do that. Equally, the CSRD asks you to identify and essentially report on your exposure to physical climate risk, and then explain that in financial terms. So what is your financial exposure across your sites to physical climate risks? And you may remember we looked at that appendix that showed you the different climate hazards. That's also something that you essentially need to do under the EU taxonomy to show that you're appropriately managing your climate risks. So I think looking for these synergies is a good way to go, as that essentially makes for a more efficient process. I can see there's perhaps one other question in the chat, which just says, so do we see many companies reporting on their non-core activities under the EU taxonomy? So for example, a manufacturing company wanting to report their work in developing clean energy. So I think there's you would essentially want to be determining some sort of materiality threshold. So you may come to some decision internally. Maybe it's, if for example the activity does not generate more than 1% of revenue, or it might be a slightly different threshold. But I mean, I think, yeah, that's the main calculation as to whether or not you would include non-core activities. Broadly speaking, what you're trying to do is report all of your activities to cover 100%. So I think you just need to determine whether or not there's a de minimis aspect, and therefore if it's worth going down that route. I think that is the other sort of aspect with this, is just determining the level of effort that you might need to put in for something that may be quite small. But generally speaking, I think the idea of the taxonomy is that you're supposed to be reporting everything. And then there's also just a question of whether or not that might be included within your CapEx or your OpEx if you are, putting, say, clean energy into your systems as opposed to selling it as a product. So there's also a bit of nuance there. But yeah, I think that's probably it for questions. In which case, I'll say thank you ever so much, everybody. And if you want to join next week, Monday at the same time, so 12 p.m., we'll be talking more in detail about the climate risk assessments and adaptation plans.
Thank you, Sam.
Thanks.
I'd just like to add, sorry, everyone who's attended, I can see there's a question about the slides. The recording will be shared with everyone by email after, and we're very happy to get in touch. There'll be some contact information in there. So thank you.
Great, thanks. Have a good day. Bye-bye.